Welcome back to Investing Talk podcast. Today we are focusing on LG Display and really tackling a question that seems to be everywhere right now. Is now a good time to buy the stock, especially after such a big run-up?
Yeah, it's a really interesting one.
It is. I mean, we're looking at a global leader here, but a company that's right in the middle of this huge kind of high-stakes strategic change. And that change has pushed the stock way up to 52-week highs recently. So it's a compelling story. Potential turnaround, definitely.
With some serious questions underneath, for sure.
Absolutely. Now, before we really get into the weeds, just a reminder, if there's a specific company you want us to take a look at, please do leave a comment below. And of course, please subscribe and hit that like button. It helps us keep this analysis coming your way.
Right. And our goal today, really, is to cut through some of the noise surrounding LG Display. We'll dig into the fundamentals, look at the technicals, the charts, and talk about the catalysts that are coming up. We want to give you, the listener, a clear, impartial view of what's actually going on with this complex player in the display panel world.
And maybe answer that central question. Can LG Display pull off this big, expensive pivot to OLED faster than the market cycles potentially work against them?
That's the crux of it.
Okay, let's start unpacking that with the fundamentals then. Big picture first. LG Display is, it's the leader globally in large panel displays, especially OLEDs.
They have dominant shares in premium TV panels, which is huge, but also in these really important growth areas like automotive displays and high-end IT.
And that leadership shows up in the revenue numbers, right? The trailing 12 months, the TTM revenue is huge.
It is. It's sitting at 26.31 trillion Korean won. That translates to roughly $19.4 billion US.
19 billion. And on the surface, the annual growth looked pretty strong, didn't it, for 2024?
Yeah, almost 25% annual growth reported for the full year 2024. It looks great at first glance.
But, and this is where it gets tricky, the sources we looked at highlighted a pretty sharp slowdown more recently.
That's right. The last quarter, Q2 2025, actually saw a revenue decline year over year, about 16.7%.
Okay, so there's that paradox you mentioned earlier, big long-term potential versus this short-term dip.
And this is exactly why that strategic pivot they're making is so critical to understand. The sources suggest that revenue drop wasn't like a total failure across the board. It seems pinned mostly on cyclical weakness in their older business, particularly traditional IT panels.
The legacy stuff.
The legacy stuff, exactly. But crucially, that weakness was partly canceled out by really strong momentum in their new focus area. High-margin OLED shipments.
Okay, let's talk profitability then, because this feels like the absolute core of the story. TTM net income is still negative.
Still negative, yes. About minus $495 million US over the last 12 months. But, and this is important, those losses are narrowing quite significantly, actually.
And that's because they're shifting away from the low-margin, commoditized LCD screens.
Right, and doubling down on the high-margin OLED tech, especially pushing hard into automotive industrial applications. Those are much stickier, higher-value markets.
Okay, but then there's this figure from the Q2 report that seems, almost too good to be true. Despite the revenue dip, they reported positive net income.
Yes, that's the figure causing a lot of debate. Operating loss improved significantly, which is good. But they also reported positive net income of 890.8 billion Korean won. That's around, $650 million US?
650 million positive. For a company that's been losing money, that sounds amazing. But you mentioned fine print, asset disposal.
Exactly. You have to read the footnotes. The sources specifically say that positive net income figure was heavily helped by asset disposal, alongside the benefits of the strategic shift itself.
So selling stuff off, what does that really mean for someone looking long-term? Is it sustainable?
Well, it means you have to be careful, right? You don't want to confuse a one-time gain from selling, say, old equipment or maybe some property with genuine, ongoing operational profit. Selling assets cleans up the balance sheet, which is good housekeeping, but it's not recurring revenue. It doesn't tell you if the core business engine is truly fixed yet.
So the real question is that high-margin OLED business growing fast enough now to make them profitable without selling off assets?
That is the billion-dollar question, quite literally. What's interesting is that management seems to be doing this cleanup while pushing the pivot. It signals they're serious.
Okay. And what about their guidance? What are they telling the market to expect next?
For Q3 2025, they're guiding for a slight revenue contraction, actually. Low to mid-single-digit % decline. But they also expect continued growth in those key auto and OLED panel shipments. And they emphasize cost discipline. So the idea is even if overall revenue dips slightly, The quality of revenue and the margins should hopefully keep improving long term.
Right. Focusing on the profitable parts. Okay, so if the financials are improving, maybe with some caveats, how's the stock market reacting? Let's look at the technicals, the chart, because that price action has been pretty wild.
It really has. It tells a story of a major recovery. The stock's currently trading around, what, $5.41?
Yeah, right at the 52-week high. The range was $2.43 to $5.44. So it's basically doubled, more than doubled from the lows over the past year.
122% recovery. That kind of move usually isn't just random noise. It suggests the market is starting to believe that maybe, just maybe, LG Display is finally getting over that hump they've struggled with for years.
And technically, the chart confirms that bullish view.
Oh, absolutely. You see a clear breakout above that key $5.40 resistance level. And importantly, it's trading strongly above both the 50-day moving average, which is around $4.50, and the 200-day, way down to $3.53.
Okay.
That pattern, that accumulation above key levels, usually signals strong buying, likely institutional confidence building in this turnaround narrative.
But whenever a stock runs up that fast, 122%, you have to wonder if it's gotten ahead of itself, right? What about momentum indicators? Any warning signs for the short term?
That's the next check. The 14-day relative strength index, the RSI, is currently up at 73.87.
Uh-oh. Above 70.
Yeah, exactly. So that confirms the strong bullish momentum, no doubt about it. But for investors, that number is also a flashing yellow light. An RSI above 70 technically means the stock is considered overbought.
Meaning it could be due for a pullback or consolidation soon?
It increases the probability, yes. Doesn't guarantee a drop, but it suggests that after such a steep climb, some profit-taking in the near term wouldn't be surprising at all. You need to be cautious entering at these levels.
Okay, caution on the short-term entry. Now let's pivot to maybe the biggest elephant in the room for LG Display. The
Yes.
balance sheet. You mentioned debt earlier.
Yes, and this is absolutely critical for understanding the valuation here. You just need to look at the difference between the enterprise value, or EV, and the market cap. The market cap, the value of the company's shares is bouncing around, say, 4.7 to 5.2 billion US dollars.
Right.
But the enterprise value, which includes debt and represents the theoretical cost to buy the whole company, is way higher. It's $13.95 billion.
Wow. So EV is almost triple the market cap. That screams high debt, doesn't it?
It absolutely does. That huge gap is almost entirely reflective of the total debt they're carrying. And you're right, the whole bull case, the entire investment thesis, really hinges on their ability to generate enough cash to start closing that gap.
So management must be focused on this.
They seem to be acutely aware. The sources mentioned they're actively deleveraging. They even cited a recent 40 percentage point reduction in their debt ratio. And importantly, they stated liquidity is still adequate for their working capital and the investments needed for this OLED pivot.
Okay, so they're working on it. And while that debt number looks scary, you mentioned cash flow improving.
Yes, and this is the potential light at the end of the tunnel, maybe. Free cash flow, the actual cash generated after expenses and investments, has turned positive in recent quarters.
That's a good sign.
That's a very good sign. And it leads to a price-to-free cash flow ratio, based on recent numbers, of around 8.37. Now, compared to some peers in the display sector, that actually looks quite attractive.
Interesting. So high debt, yes, but the cash generation engine might be starting to fire up again, making the valuation relative to cash flow look potentially reasonable.
Potentially, yes. It's that tension between the debt overhang and the improving cash flow that makes this so interesting.
Okay, let's shift gears then to what could drive the stock over the next, say, 3 to 12 months. Catalysts, sentiment, and of course, the risks we need to keep in mind. Sentiment seems pretty hot right now.
Yeah, the sources describe crowd sentiment as very positive, and the stock has definitely outperformed its sector peers recently.
And are the big players, the institutions, buying in?
It looks like it. Institutional ownership is pretty high, around 15.5%. And the sources specifically mention big hedge funds, like Millennium Management, increasing their positions recently. That's usually a signal of strong conviction.
What about Wall Street analysts?
The official consensus rating is currently a hold, but importantly, the trend in their earnings estimates is upwards. They seem to be factoring in that cyclical recovery and the positive impact of the OLED shift. So, hold, but with a positive bias, you could say.
Okay. What are the specific confirmed events coming up that could move the stock?
The big one, no surprise, is the next earnings report. Q3 2025 earnings are scheduled for October 22nd.
And what will people be watching for?
Given the strategic shift, I think the market will be laser-focused on margin performance and the revenue growth specifically from that automotive OLED segment, probably more so than the overall top-line number. Beyond earnings, other things to watch are any announcements about major new auto or industrial panel contracts. And they usually showcase new tech at fall trade shows, which can generate buzz and signal future product directions.
Okay, those are the knowns. Now, what about the unknowns? The speculative stuff, the rumors swirling around that could be game changers if they turn out to be true.
Right, the aha moments investors are hoping for. There are a few big ones mentioned. First, persistent market chatter about a potential major strategic partnership with a big global automaker
For what specifically?
for integrated OLED dashboard systems. Think entire dashboard displays, not just small screens. This would be huge, embedding them deeply into the auto supply chain for years to come. A massive win.
Okay, that's big. What else?
Second, the perennial speculation about LG Display landing a really large, multi-year panel contract for future Apple devices. Getting a big chunk of that Apple volume would obviously be a massive boost to cash flow and could help tackle that debt problem much faster.
Always the Apple rumors. And number 3.
Third, there are whispers they might be accelerating the commercialization of their next-gen blue phosphorescent OLED panels. This is more technical, but if they pull it off ahead of competitors, it could really cement their technological leadership in displays for the next decade.
Wow, okay. So some potentially massive but unconfirmed catalysts out there. But we have to balance that excitement with the risks, right? Let's be clear about those.
Absolutely crucial. First, the company-specific risk is crystal clear. It's that high debt load and the fact that TTM net income is still negative. Yes, they're cleaning up the balance sheet, but if there's a sudden economic downturn, servicing that debt gets much harder very quickly.
Makes sense. And the sector itself.
The display panel industry is just notoriously cyclical. It always has been. It's very sensitive to macroeconomic conditions, consumer spending, and you can see wild swings in panel pricing. That's a risk you just can't avoid in this sector.
Okay, so putting it all together then, high risk, high potential reward. How do the sources rate the overall story?
Based on the factors we've discussed, the sources lean bullish, giving it an overall rating sort of conceptually of 8 out of 10.
An out of 10.
Yeah.
And the rationale behind that bullish lean.
It boils down to a few key things. They are the leader in OLED innovation, that's clear. They have a defined strategy shifting into higher value markets like automotive. That structural pivot seems to be underway. And the technical picture, the chart, confirms that big money, institutional money, seems to be betting on this turnaround story working.
So who is this stock potentially attractive for then?
Well, based on the analysis, it seems potentially appealing for a couple of different types of investors. For short-term traders, you've got that strong technical momentum, plus the upcoming Q3 earnings catalyst, which could cause volatility. And then for longer-term investors, the appeal is really betting on that structural shift, believing that the move into high-value OLED segments like auto and industrial displays will eventually pay off big time, overcoming the debt issues.
Right, it caters to both, potentially. Okay, final thought then. Something for our listeners to chew on.
Okay, here's the critical question I think you need to keep in mind as you watch LG Display going forward. We talk a lot about that huge gap between the enterprise value and the market cap, driven by debt. Now, if one of those big unconfirmed rumors actually happens, say a massive automotive partnership is announced or they really do win a huge multi-year Apple contract,
Yeah.
those kinds of deals would dramatically increase their operational cash flow, potentially quite quickly. So the question is, how fast could management use that new flood of cash to pay down the debt that's inflating the enterprise value?
So it comes back to closing that EV/MC gap.
Exactly. If they can significantly shrink that debt burden rapidly, using cash from major new wins, the entire valuation story for LG Display changes. It would fundamentally re-rate against its peers. That's the ultimate catalyst investors are watching for. So keep a very close eye on those cash flow figures and any news related to those big potential partnerships.